Okay, so you want to own a mobile home park, a few roads, some utility lines, rows of homes you did not build, do not maintain, and usually do not own. Every month, the residents pay you rent for the small rectangle of land underneath them. No apartment interiors, no hotel housekeeping, no restaurant inventory, just land, infrastructure, and recurring rent. On paper, it looks like one of the cleanest businesses in American real estate. It is not that simple. Because in this business, the resident may own the home but not the ground below it, and that creates one of the strangest financial relationships in housing. The tenant owns the expensive object. The landlord owns the part that cannot move. That sounds backward until you understand the economics. More than 20 million Americans live in manufactured housing. Many are retirees, working families, people with disabilities, and residents of rural communities where conventional housing has become too expensive. For them, a manufactured home can offer something increasingly rare in the United States, a detached home at a price below a typical site-built house. But if that home sits inside a privately owned community, the resident may pay a monthly lot rent for the land, roads, utilities, and shared services. The home may belong to the resident, the address belongs to the park, and the address is where the leverage lives. Before you collect $1 of lot rent, you need a property. A real mobile home park is not simply an empty field with optimistic plumbing. It needs roads, drainage, water, sewer or septic systems, electrical connections, streetlights, mail areas, fire access, landscaping, waste service, and enough legal approvals to convince the local government that hundreds of homes can remain there for decades. Some communities also include clubhouses, pools, playgrounds, storage, offices, gates, and common areas. The homes may be privately owned, but the underground pipes are your problem. And underground pipes have a powerful ability to remain invisible until they become extremely expensive. A broken water line does not care that the property has strong occupancy. A failed septic system does not accept investor presentations. The road still needs repair, stormwater still needs somewhere to go, trees still fall, insurance still renews, property taxes still arrive, and if the community owns its own water system, the park owner has entered the exciting world of utility regulation without receiving a complimentary hard hat. The first way to enter the business is to develop a new community. That is harder than it sounds. Many cities resist new manufactured housing developments. Neighbors may object, zoning may prohibit them, land may be approved for apartments, warehouses, or single-family subdivisions, but not for manufactured homes. Even when approval is possible, the process can take years. Then the developer must build infrastructure before most residents arrive. Roads, utilities, and drainage cost money while empty lots produce nothing. A finished site without a home is a very organized piece of dirt. This limited new supply is one reason existing communities are valuable. The country needs affordable housing. New manufactured homes can be built efficiently in factories, but creating new places to install them is often politically and economically difficult. So investors look at existing parks. The roads are already there, the zoning already exists, residents already pay rent, the homes are already installed. The difficult part has already been completed by somebody else. That is the first attractive feature, scarcity. The second is occupancy. Large public operators have reported occupancy in the high 90s across manufactured housing portfolios. That is an extraordinary number in real estate. An apartment can become vacant because a tenant finds another apartment. An office can become vacant because a company changes buildings. A manufactured homeowner cannot simply put the house in a backpack and leave. Moving a home may require permits, preparation, disconnection, transport, a specialized contractor, a suitable destination, and new utility connections. The structure may be too old to move. The route may be impossible. The new community may not accept it. The cost can run into thousands or tens of thousands of dollars, and there may be no open lot nearby. This is why the word mobile can be misleading. The home arrived on wheels. That does not mean it still has somewhere to go. The third attractive feature is low turnover. When a resident owns the home, leaving the community is harder than leaving an apartment. They can sell the home to another buyer, assuming the buyer is approved by the park. They can attempt to move it. They can abandon it, which is usually financially disastrous, or they can remain and keep paying lot rent. Investors call that tenant retention. Residents may call it not having a realistic alternative. Those are two descriptions of the same occupancy report. Now let us look at how the park actually makes money. The first layer is lot rent. Each resident pays monthly rent for the site beneath the home. The payment may include access to roads, common areas, trash service, water, sewer, or other amenities, depending on the property and lease. A park with 200 occupied sites collects 200 separate monthly payments. No single tenant controls the property. If one resident leaves, the other 199 continue paying. That diversification is valuable. The second layer is utility income. Some communities include utilities in rent. Others bill residents separately. The park may submeter water, sewer, electricity, or trash. Billing residents directly can reduce waste and protect the owner from rising utility costs. It can also create disputes if rates, meters, fees, or maintenance are unclear. Nothing creates neighborly warmth like a surprise water bill from the company that also owns the road. The third layer is home sales. Some community operators own homes inside the park and sell them to residents. A vacant site earns nothing. Placing a new manufactured home on that site can create a sale and a long-term lot renter. The operator may work with manufacturers, dealers, lenders, and buyers. The home sale produces immediate revenue. The site rent continues afterward. The company is not simply filling an empty lot, it is installing the future customer. The fourth layer is rental homes. Instead of selling every home, the park may own some and rent them out. Now the owner collects both the value of the home and the land. The monthly revenue is higher, so are the responsibilities. A resident-owned home has its own roof problem. A park-owned rental home has your roof problem. The fifth layer is fees. Late fees, application fees, pet fees, storage fees, parking fees, administrative fees, charges for amenities or services. Each fee may be small. Across hundreds of sites, small fees become a line item, but this is also where the business can damage trust. A resident can understand rent. A resident becomes less enthusiastic when the monthly statement begins reading like an airline ticket. The sixth layer is expansion. An existing park may contain vacant land or unused sites. Adding new pads can increase revenue without buying another property. The roads, office, staff, and brand already exist. Each additional occupied site can produce incremental income. That is one reason investors examine density so carefully. A park with 200 homes may actually be a park with 200 homes and 20 future rent checks waiting in the grass. The seventh layer is appreciation. If rents rise and operating income improves, the entire property may become more valuable. Real estate investors often value income-producing property based on its net operating income and the market capitalization rate. Increase annual income, and the valuation can rise by far more than the amount of the rent increase itself. This is where the spreadsheet becomes excited. Suppose a park raises average rent by $50 per month across 200 sites. That is $10,000 of additional monthly revenue, $120,000 annually before additional expenses. At a given capitalization rate, that new income may add millions of dollars to the theoretical property value. To the resident, it is $50. To the investor, it may be a seven-figure event. That difference explains why manufactured housing communities attracted institutional capital. For decades, many parks were owned by local families or small operators. The owner knew the residents. Rents may have remained below market for years. Infrastructure may have been repaired slowly. Then the owner retired. A professional buyer arrived. The buyer did not see a quiet neighborhood with inexpensive rents. The buyer saw underpriced land, high occupancy, limited competition, and residents who were expensive to move. The phrase under market sounds harmless in an acquisition model. To the person living there, it means the new owner believes the rent should be higher. Institutional investors can bring real advantages: capital for roads, water systems, clubhouses, and security, professional management, online payments, better accounting, new homes for vacant sites, purchasing power, access to financing. A neglected family-owned property may need exactly that. But the same investment logic can create pressure for faster rent growth and more fees. The investor may have paid a price based on aggressive income assumptions. The loan may require those assumptions to become reality. The property may be affordable to the resident precisely because the previous owner was not maximizing every dollar. The new owner may consider that inefficiency. This is the central conflict of the business. The park is housing. The park is also an investment. Housing wants stability. Investment wants growth. Both occupy the same lot. In late 2025, a U.S. Senate investigation asked several corporate owners of manufactured housing communities for information about rent increases, fees, maintenance, evictions, and resident conditions. The letters pointed to public concerns that residents often have limited ability to relocate their homes and that investment firm ownership had increased. An investigation is not a finding that every operator acted improperly, but the questions reveal why this industry receives political attention. A normal landlord raises rent and the tenant can search for another apartment. A park owner raises lot rent and the resident may need to move an entire house. The price of leaving changes the balance of power. That does not mean the owner can raise rent without consequences. Residents can organize. States and cities may regulate increases, fees, closures, or sales. Some jurisdictions give residents advance notice when a park is offered for sale. Some allow residents an opportunity to purchase it. Rent control laws may limit income growth. Poor management can create lawsuits, enforcement, reputational damage, and political pressure. A landlord may own the ground. They do not own the legislature. Now for the other side of the ledger. Infrastructure. Older parks can contain aging water lines, sewer systems, electrical equipment, roads, and drainage. A property may look stable above ground while becoming financially experimental below it. Replacing underground systems across a full community can cost millions, and repairs are difficult because residents are already living there. You cannot casually close the road, remove the water, and tell everyone the renovation concept is industrial minimalism. Insurance is another problem. Manufactured housing communities may be exposed to hurricanes, floods, wildfires, tornadoes, freezes, and other disasters. The park owner may insure common infrastructure and owned buildings. Residents insure their homes separately. A storm can damage both. The park may lose revenue while repairs continue. Roads and utilities may need restoration before residents can safely return. Then there is property tax. As investors pay higher prices for parks, local assessments may rise. The new owner may respond by raising rent. Residents blame the owner. The owner blames taxes. The assessor has already left the conversation. Management is also more demanding than the passive income pitch suggests. Rules must be enforced, applications screened legally, common areas maintained, disputes handled, abandoned homes addressed, utilities monitored. Residents notified, contractors supervised, local laws followed. A manufactured housing community is not a parking lot for houses. It is a neighborhood with a private infrastructure department. Then there are vacant homes. If a resident abandons an old home, the structure may have little value and a large removal cost. The park cannot rent the site until the home is sold, repaired, or demolished. A metal box that once created occupancy can become an expensive sculpture dedicated to deferred maintenance. Financing can also become a trap. A buyer acquires the park using debt based on expected rent growth and occupancy. Then regulation limits increases, infrastructure fails, insurance rises, residents resist fees, a recession weakens home sales. The property remains full, but the cash flow does not meet the loan assumptions. This is the unusual danger. High occupancy can hide financial stress. The residents are still there. The owner still has a problem. Now look at a large operator. In 2025 Investor Materials, Sun Communities described a North American manufactured housing portfolio of hundreds of communities and roughly 97,000 sites, with occupancy above 97%. Rental income generated the overwhelming majority of that segment's net operating income. That is the model at institutional scale. Thousands of small land leases producing recurring revenue across many states. The company does not need one resident to pay a fortune. It needs tens of thousands of residents to keep paying predictable amounts. Scale provides purchasing power, financing access, centralized systems, and geographic diversification. It also makes every 1% change meaningful. A 1% rent increase across 97,000 sites is not 1% in the way normal people experience it. It is a corporate event. But there is another ownership model. The residents can own the park themselves. In a resident-owned community, homeowners form a cooperative or similar organization and purchase the land collectively. Residents still pay monthly charges. The roads still need repair. The water system still breaks. There is no magical disappearance of cost. But the community controls the budget, long-term rent policy, and major decisions. The land is no longer owned by an outside investor trying to maximize a resale value. Freddie Mac and other institutions have financed resident-owned communities and describe them as one method of preserving long-term affordability. This model has challenges. Residents must organize. They need financing. The purchase price may be high. The infrastructure may need work. The community must govern itself. Meetings happen, budgets happen. Someone must explain why the pool cannot be renovated before the sewer line. Democracy has operating expenses too, but resident ownership changes the central incentive. The people paying the rent also control the land. The home and the ground stop belonging to opposing balance sheets. So does owning a mobile home park actually work? In the optimistic version, yes. You buy a well-maintained community at a reasonable price. The infrastructure is documented. Water and sewer systems are reliable. Rents are affordable but sufficient to support operations and reserves. Residents stay for years. Vacant sites are filled with new homes. Rules are clear. Fees are limited and transparent. Management responds quickly. Capital improvements protect the property. Rent grows gradually rather than violently. The community remains desirable. The owner earns stable income. Residents retain affordable housing. The business works because both sides can remain for a long time. Now the realistic bad version. You buy the park at a high price using aggressive debt. The acquisition model assumes immediate rent increases. Residents are already financially stretched. Water lines fail, roads need replacement, insurance doubles, the local government requires upgrades. You add fees. Residents organize, the press arrives, regulators ask questions. Home sales slow because buyers see rising lot rent. Vacant sites remain empty. The park is still occupied, but the relationship is collapsing. You bought stable housing and financed it like a turnaround. The homes did not move, the trust did. That is the death spiral. Higher debt requires higher rent. Higher rent reduces affordability. Lower affordability weakens home values and buyer demand. Weaker demand creates vacancies and abandoned homes. Vacancies reduce revenue. The owner needs more income from the remaining residents. The affordable community becomes less affordable because the investment required it to become more valuable. The building is not the asset in this business. The inability to move the building is the asset. That is the sentence investors rarely put on the sign at the entrance. A mobile home park is not really renting land. It is renting permanence. The resident places a home, builds a porch, plants a garden, meets neighbors, receives mail, and creates a life around one lot. Every year, the home becomes less mobile and the relationship becomes more valuable to the owner. That can create stability. It can also create vulnerability. The best operators understand that long-term profit depends on keeping the community livable, trusted, and affordable enough for new buyers to enter. The worst operators see the cost of leaving and mistake it for unlimited pricing power. It is not unlimited. Residents vote, residents organize, residents call journalists, laws change, homes lose value, communities deteriorate. A landlord can raise the rent faster than the pipes can be repaired. That does not make the property better. The strange beauty of the business is that it can align everyone's interests. Stable residents create stable revenue. Well-maintained infrastructure protects homes and land values. Reasonable rent supports occupancy and home sales. Long-term ownership rewards patience. The strange danger is that the same business can profit from the residents' lack of alternatives. The home may have arrived on wheels. The profit begins when the wheels are gone.